If you believe that making more money in the markets requires entering more trades, you are actively funding the accounts of professional operators. The market is not a corporate job where physical labor correlates to financial compensation. It is a psychological trap that systematically liquidates the hyperactive. The fundamental reality of the market environment is that it possesses no inherent structure. Unlike any ordinary social domain where rules are imposed externally to restrict, guide, or protect human behavior, the market presents a state of absolute unmitigated freedom. You can buy, sell, scale, or stand aside at any given microsecond of the trading day. However, it is precisely within this boundless environment that the untrained psychological framework of the average retail participant completely collapses. If your underlying belief structure dictates that generating greater financial output requires a corresponding increase in physical or technical activity, you are operating under a catastrophic misconception. The psychological mechanism that equates more effort and more action with more reward is highly effective in a traditional career, but it acts as a direct path to financial self-destruction inside the market space. When you enter a transaction based on the compulsive need to catch every single price movement, you are not trading, you are simply seeking a physiological high from market activity. The market does not reward the individual who interacts with every single candlestick from the opening bell to the daily close. The market rewards the operator who possesses the structural discipline to remain completely passive until a high probability edge manifests. By chasing every minor fluctuation, you are allowing the random noise of price action to dictate your emotional state. To transition from a state of consistent losses to a state of sustained consistency, you must first accept that more action does not equate to more income. In fact, an escalation in trading frequency almost universally correlates with an inflation of execution errors. This stark realization forces us to look directly at the true source of a trader's failure. Not the chart patterns or technical indicators, but the deeply hardwired mechanics of the human mind, which immediately transitions our focus toward the psychological adversary within your cognitive framework. The screen in front of you is not a financial chart. It is a mirror reflecting your deepest psychological flaws. The market cannot make you lose money, it cannot cheat you, and it doesn't know you exist. Your actual opponent is looking right back at you in the glass. The market is a cold, neutral mirror. It doesn't know you exist. It has no intent to harm you. It cannot manipulate data to target you. And it is entirely incapable of caring about your financial well-being. Therefore, your primary adversary in this environment is never the market, nor is it the institutional algorithms, the market makers, or other retail participants. Your primary adversary is your own cognitive architecture. The human brain evolved over millennia to seek safety, comfort, certainty, and immediate patterns to avoid psychological and physical discomfort. When confronted with the pure randomness of price delivery, the untrained mind automatically projects its internal fears, greeds, and desperate desires onto the data screen. If a single green candle prints rapidly, the mind instantly manufactures an artificial narrative of missed opportunity, triggering an intense wave of the fear of missing out, FOMO. If a red candle prints, the mind immediately projects a threat to survival, forcing an irrational panic response. Consider the behavioral loop of thousands of retail market participants. The opening bell rings, and they immediately anchor themselves to the screen without an objective, statistically validated plan. They proceed a sudden upward thrust in price and execute a long position purely out of emotional impulse. The moment price ticks even a single pip against them, they experience immediate cognitive dissonance. To escape the psychological pain of being wrong, they execute an unplanned counter-trade, average down, or hold a losing position in the irrational hope of a reversal. When the loss expands exponentially, they double their position size, fundamentally violating all parameters of risk management. At the conclusion of the session, as they face an exhausted and broken account balance, they externalize the blame entirely, concluding that their technical strategy, moving average, or indicator setting is flawed. They fail to realize that the strategy was completely irrelevant to the outcome. The breakdown occurred entirely within their inability to manage their internal mental environment, a structural deficit that highlights the profound, unyielding difference between a professional approach and a novice mentality. specifically when analyzing how. The deep divergence between professional and amateur logic 2 traders can look at the exact same chart, execute at the exact same price level, using the exact same strategy, yet one will walk away wealthy while the other completely blows their account. The difference has absolutely nothing to do with technical knowledge. If we examine a professional operator and a struggling novice side by side, we find that they are frequently looking at the exact same charts, utilizing the identical moving averages, and mapping out the same support and resistance zones. The difference is not an asymmetry of technical information or secret data feeds. The divergence lies completely within their psychological relationship with the unknown. The novice trader looks at the screen with an underlying psychological demand: the market must validate me today, and I must extract money right now to prove my analysis is correct. This rigid demand forces them to actively hunt for setups where absolutely none exist, transforming minor market noise into artificial trading opportunities because their ego cannot handle the concept of stillness. Conversely, the professional trader operates with a mind completely free of expectations regarding what the market will do next. The professional understands that they have absolutely no control over the market's behavior, but they maintain total, uncompromised control over their own behavior. The professional knows exactly what a valid edge looks like, and more importantly, they possess the psychological discipline to know when not to execute a trade. To a disciplined professional, a market session that offers no high probability setups is not a wasted day. It is a highly successful exercise in capital preservation. They view the preservation of their financial resources as an absolute victory because they operate under the core axiom that protecting the trading account is the absolute prerequisite to capitalizing on future market states. A critical realization that brings us to the absolute foundational law of trading survival: capital preservation as the supreme market directive. The absolute secret to making money in trading is focusing entirely on how not to lose it. Amateur traders obsess over potential profits. Professional operators obsess over potential risk. If you don't flip this priority today, the market will permanently retire you. To survive in this environment over an extended horizon, you must completely invert your hierarchy of priorities. The amateur trader places profit generation at the absolute peak of their focus, treats risk management as an afterthought, and often abandons it completely the moment an emotional trigger occurs. The professional trader, operating with a completely objective perspective, places capital preservation as the absolute, non-negotiable supreme directive. Profit is structurally categorized as a secondary byproduct of executing a statistically valid edge over a large enough sample size of trades. Think about this logically. If you allow your capital base to be eroded through a series of highly impulsive, emotionally charged overtrades, you are effectively removing yourself from the game. When the true, unmistakable high-probability structural edge finally materializes on the chart, you will find yourself completely incapacitated, either because your capital is entirely depleted or because your psychological capital has been so deeply fractured by previous losses that you are too paralyzed to pull the trigger. The market offers a perpetual, infinite stream of opportunities. It will outlive all of us. But your capital is finite. If you do not master the precise art of doing nothing when the market conditions are unfavorable, your capital will vanish long before the next major market trend develops. This requires a level of patience that parallels the raw mechanics of an apex predator in the wild, which operates under the exact psychological framework where the sniper methodology and the power of selective execution. A sniper doesn't empty their magazine into the dark hoping to hit something. They wait hours for a single, perfect target. If you are clicking your mouse button every 10 minutes, you aren't a trader. You are just a casualty of market noise. Elite marksman sitting in a concealed position does not fire their weapon at every rustle of a leaf or every minor movement in the brush. They do not operate on impulse, boredom, or random stimulation. They have a highly specific, predefined set of environmental criteria that must be perfectly met before they take action. Wind velocity, distance, target visibility, and stability. They wait hours, sometimes days, for all these variables to align perfectly. If the criteria are not met, they remain completely still, experiencing absolutely no psychological distress, anxiety, or sense of missed opportunity. They know that a single premature shot will completely compromise their entire mission. The professional trader functions exactly like this sniper. They do not view a fast-moving, volatile candle as an invitation to randomly interact with the market. They recognize that a rapidly moving price bar is often nothing more than a psychological trap designed to exploit the emotional vulnerabilities of undisciplined participants. They stand back, observe the structural context of the price delivery, and wait until the mathematical probabilities shift decisively in their favor. Within this framework, patience is not a passive state of weakness or hesitation. It is an active, highly calculated expression of psychological strength. Yet, the overwhelming majority of retail traders find this level of stillness completely impossible to sustain, because the moment the price begins to accelerate, their internal mental landscape becomes flooded with an overwhelming cognitive distortion, known as FOMO, which inevitably leads to a critical crossroad. Confronting FOMO and the addiction to market stimulation. The fear of missing out is the single fastest way to empty your bank account. When you jump into a trade just because price is pumping, you aren't capturing an opportunity. You are providing liquidity for the professionals who are selling to you. The psychological phenomenon of the fear of missing out, FOMO, is a direct consequence of a trader operating with a rigid expectation of what the market should do, rather than accepting the reality of what the market is doing. When you watch a parabolic price move occur without you, your ego interprets that move as a personal loss, a validation that someone else is profiting while you are being left behind. This belief structures an immediate state of internal panic. The mind screams for action, forcing you to execute a market org at the absolute worst possible structural location, typically right at the peak of an exhausted expansion leg, right before the market reverses violently to hunt the stop losses of late entrants. At this stage, you must confront an incredibly uncomfortable question. Are you interacting with the financial markets to build a highly structured, scalable business? Or are you simply using the market to feed a psychological addiction to constant stimulation and excitement? Many individuals claim they want financial freedom, but their behavioral patterns prove they are actually seeking the raw neurological hit of uncertainty and action. They require an entry every 10 minutes, they need to be involved in every single market rotation, and they demand a profit from every single session. They treat the market like a casino, completely blind to the reality that the market is a cold mechanism designed to transfer wealth from the emotionally addicted to the psychologically disciplined. This fundamental shift from chasing excitement to executing a rigid process requires a complete re-engineering of how one approaches risk acceptance, forcing us to analyze the complete pre-acceptance of risk and probability dynamics. If you feel your heart racing or your palms sweating when a trade moves against you, you have not accepted the risk. You are gambling with money you are psychologically terrified to lose, and the market will exploit that fear every time. The defining characteristic of an elite trader is the ability to operate completely free of fear, hesitation, or internal conflict. This pristine mental state can only be achieved when you completely and unequivocally pre-accept the risk of every single transaction before you ever execute the trade. If your mind has not genuinely accepted the exact dollar amount you are risking on a trade, the moment that trade enters live market space, your survival mechanisms will completely hijack your rationality. You will become hyper-focused on every single tick against your position. You will experience a suffocating level of anxiety that forces you into making a series of catastrophic execution errors. To truly pre-accept risk, you must train your mind to look at the market through a purely probabilistic lens. You must understand at the deepest level of your belief system that any given trade is nothing more than one single event in a large series of trades. Let us mathematically assume your trading edge possesses a 60% win rate over a sample size of 100 trades. Within that series of 100 trades, there is a statistical certainty that you will encounter a sequence of 5, 7, or even 10 consecutive losing trades completely at random. If you have truly accepted this statistical reality, a single losing trade carries absolutely no emotional weight. It is simply a cost of doing business, entirely equivalent to a restaurant owner buying inventory. However, if you are trading with an oversized position where a loss will severely damage your account or your ego, you have not accepted the risk. The fear will cause you to cut your winning trades instantly out of fear of losing a small gain, while holding on to your catastrophic losing trades in a desperate gamble that the market will return to your entry point, an emotional distortion that completely corrupts the concept of strategy execution and brings us to the core realization that the absolute supremacy of internal discipline over strategic perfection. Stop buying courses looking for the 100% win rate strategy. It does not exist. A professional trader can make millions with a 40% win rate, while a novice will go bankrupt with an 80% win rate due to zero discipline. The retail trading industry has built a multi-million-dollar marketing machine designed to sell the illusion of the holy grail mechanical strategy. Struggling traders spend months or years cycling through an endless loop of technical indicators, smart money concepts, and complex algorithmic models, completely convinced that their inability to achieve consistency is a technical problem. This is a massive psychological avoidance tactic. The painful truth that most traders refuse to confront is that a highly disciplined individual operating with a completely average, mediocre technical strategy that possesses a modest edge will consistently generate substantial wealth over time. Meanwhile, an emotionally volatile, undisciplined individual operating with a technically flawless, highly advanced strategy will systematically destroy their account. The strategy does not execute itself. It must be executed through the filtering mechanism of your human mind. If your mind is fundamentally fragile, prone to anger, greed, revenge, trading, and impatience, then no strategy in existence can save your capital. The market is an environment that actively scans for your deepest psychological vulnerabilities and weaponizes them against your financial capital. Two individuals can sit in the exact same room, looking at the exact same candlestick chart, utilizing the exact same strategy parameters. One will execute flawlessly, manage risk according to strict parameters, and exit the month with consistent profitability. The other will continuously break rules, over-leverage, chase false breakouts, and exit the month completely liquidated. The difference is entirely contained within their internal psychological framework, which dictates how they manage their open positions after the initial entry is taken, leading us directly to the mechanics of open position management and behavioral controls. Finding the entry is the easiest part of trading. What you do after you pull the trigger determines whether you are a professional business owner or an emotional wreck praying for a green candle. The real money is made in trade management. The ultimate test of a trader's psychological maturity does not occur when they are searching for an entry setup. The true evaluation of your mastery over the self begins the exact moment after you pull the trigger and your position becomes a live liability in the market. The moment a position is active, the average novice trader enters a state of deep psychological vulnerability. If the market prints a minor countertrend candle, their mind immediately interprets it as a complete failure of the setup, inducing them to close the trade prematurely for a tiny fraction of their planned target. Conversely, if the trade moves into profit, they are consumed by a desperate urge to close it immediately to lock in the micro gain, completely denying themselves the ability to let their winning trades run to their full risk to reward target. This behavioral pattern creates a mathematically impossible equation. They consistently take tiny, fear-driven profits while absorbing massive, hope-driven losses. A professional operator understands that trade management is an exercise in absolute neutrality. Once the execution order is fulfilled, the professional's primary objective is to allow the market the structural space to either validate or invalidate the trade, based entirely on the predefined plan. They do not micromanage every single tick. They do not sit there staring at the fluctuating unrealized profit and loss statement because they know that doing so will inevitably trigger an emotional reaction. They manage the trade with the clinical precision of an institutional risk manager, knowing that true long-term profitability is never achieved by trying to control the market's path, but rather by enforcing absolute behavioral discipline over oneself, which ultimately leads us to the ultimate synthesis of market mastery, cultivating the probabilistic mindset for permanent market dominance. Consistency isn't something you find in a chart pattern, it's a state of mind. When you finally stop trying to predict the future and start trading mathematical distributions of probabilities, the game permanently changes in your favor. To ascend to the status of a consistently successful market professional, you must completely abandon the traditional cultural programming that views trading as a game of right or wrong. You must undergo a radical shift in your identity. You must stop identifying as an analyst who predicts price movement and begin identifying as a professional risk manager who executes a statistical edge over a continuous series of outcomes. You must reach a psychological state where you are completely indifferent to the outcome of any individual trade. When you achieve this level of mental neutrality, the market completely loses its power to make you afraid, angry, or greedy. The ultimate success of your trading career will be forged by the trades you choose not to take out of absolute respect for your rules, and by the losses you cut cleanly without a shred of hesitation or emotional regret. From this moment forward, establish an unyielding commitment to your process. When the market session commences, detach yourself entirely from the desire to make money. Instead, focus all of your psychological energy on executing your plan with flawless discipline. If your predefined structural setup does not manifest on the charts, celebrate that session as an absolute victory for your discipline. If this deep dive into trading psychology has fundamentally shifted how you look at the screens today, make sure to smash that subscribe button, hit the like notification, and drop a comment below stating, "I am a risk manager, not a gambler." Share your biggest struggle with overtrading so we can break down those cognitive biases together in the next video. Head over to our channel homepage to unlock the complete masterclass playlist on mechanical edge execution. Train your mind, protect your capital base, and remain completely objective. We will see you in the very next session.